Your entire financial legacy is currently sitting on a tectonic plate that just shifted. But you didn't feel the earthquake because the IRS didn't let you know. Most retirees are operating on a playbook written in 2019. But while you were focused on inflation and market volatility, the rules of the game were rewritten in the fine print of a document most CPAs haven't even fully digested. We aren't talking about a standard tax hike. We are talking about the single most aggressive attack on intergenerational wealth transfer we have seen in 40 years. You probably think your IRA is safe. You think you're setting your family up for life. But unless you understand the double tax trap buried in the new interpretation of the 10-year rule, you aren't leaving your children a nest egg. You're leaving them a tax bomb that detonates the moment you're gone. Welcome to Retire Rich. Today we're exposing a crucial rule the IRS changed in the fine print. Don't forget to like and subscribe for more videos like this. Here's the reality. For decades, the strategy was simple. The Stretch IRA. You die, your child inherits your IRA, and they stretch the distributions over their lifetime. It was the perfect vehicle for compounding growth. That vehicle has been crushed. The IRS eliminated the Stretch IRA and replaced it with the 10-year rule. On paper, it sounds benign. Your heirs must empty the account within 10 years. Simple, right? They can just wait until year 10, take the lump sum, and pay the tax then. This is exactly where the trap is set. The IRS quietly released proposed regulations that contradicted the text of the law itself. They stated that if you, the account owner, were already taking required minimum distributions when you passed away, your heirs do not just have a 10-year deadline. They have an annual liability. They must take a distribution in year 1, and year 2, and year 3. This sounds like a minor administrative annoyance. But do the math. If your daughter is 45 years old when she inherits your account, she is likely in her peak earning years. She already has a salary, maybe a spouse's salary. Now, forced by this quiet rule change, she has to add a massive chunk of your IRA income on top of her existing income every single year. This doesn't just increase her taxes, it catapults her into the highest marginal tax bracket. But it gets worse. Because this income stacks, she could lose child tax credits. She could get hit with the net investment income tax, an extra 3.8% surcharge. In some states, combined with federal rates, the government could be confiscating nearly 55% of the money you spent a lifetime saving. And you might be thinking, my estate isn't that big, this is for the ultra-wealthy. Wrong. This hits the middle-class saver the hardest. The ultra-wealthy have trusts and offshore vehicles. You have a 401k and an IRA. This rule is designed to drain those specific accounts. So, what's the antidote? You have to stop trying to save taxes while you are alive and start trying to optimize taxes for the legacy. The instinct to defer taxes as long as possible is now a mathematical error. You need to look at Roth conversions, but not the way your broker explains them. Most people convert to Roth when the market's down. That's smart. But the genius move is bracket filling. You intentionally pay taxes now at your current retiree rate, which is likely lower than your heir's future rate, to move that money into a tax-free environment. You're essentially paying the toll now so your family can drive on the highway for free later. However, there's a secondary trap the IRS laid for high-income earners, specifically regarding catch-up contributions. Previously, if you were over 50, you could throw extra money into your pre-tax 401k to lower your tax bill today. The IRS noticed this was too effective. The new provision, which many payroll departments are still struggling to implement, mandates that if you earn over a certain high-income threshold, your catch-up contributions must go into a Roth account. You lose the tax break today. They're forcing you to pay the tax now. It's a liquidity squeeze. They want their money up front. This brings us to the uncomfortable truth about the current tax code. The government has a spending problem, and your retirement account is the path of least resistance to solve it. They aren't raising rates on the billboards. They're changing the withdrawal mechanics in the footnotes. If you ignore this, you're practically volunteering for a wealth reduction. But if you execute the bracket-filling strategy we discussed and pair it with the correct beneficiary designations, specifically looking at see-through trusts rather than direct transfers, you can sidestep the 10-year minefield entirely. The window to fix this is closing, because tax rates are scheduled to sunset and reset to higher levels very soon. The math you're using today will not work tomorrow. Now, understanding the death of the Stretch IRA is only step 1. There's another asset class that avoids this 10-year rule entirely, acting as a distinct tax wrapper that the IRS hasn't figured out how to crack yet, which we'll break down in one of our next videos. So be sure to like and subscribe to find out, and we'll see you in the next one.